Hello everyone. Today I want to talk about what do you do when you have missed your entry. Let's say, for instance, now this applies on any pair. It doesn't necessarily have to apply on volatility index only. It applies on every pair. So let's say that you have seen that your market is currently at this position, right? Before it broke above this level. Let's say that you were looking to take long position upon you saw the head and shoulder pattern, right? After seeing the head and shoulder pattern, now you're still being indecisive in terms of whether you should enter or not, right? So upon the retracement, you were looking to take long positions on this pair, like you're looking to take long positions pushing the price upwards when you saw the right shoulder forming, right? So but then you missed the entry, you missed the long position entry, right? So if you miss the long position entry, what can you do? So technically what you will do is that you will wait for price to dip lower, right? Giving you a better price. So when the price reaches the neckline, you would want it to push a bit lower, giving you the retest of the supply zone, right? Of the demand zone. This is the demand zone, right? So once it gives you the retest of the demand zone, that's when you can consider taking long positions, because you have missed your initial entry. So you wait for the market to give you a better entry. So you don't enter upon when you see the market making this big movement out of the zone, right? The demand zone. So you don't enter at that particular time. You actually wait for the market to give you a better entry. So what we do whenever we trade is that we always consider a better entry. So whenever the market moves away a certain pips from where you actually planned to execute your long trade, let's say you're looking to take your execute your long trade upon the retest of this level here, which confluences with the demand zone that initially formed when the head was forming, right? So then you missed taking these long positions upon this retest of the demand zone. So what you'll actually do is wait for the market to push a bit higher, therefore getting retail traders interested in taking long positions, knowing that after they get retail traders interested in taking long position, then traders will actually move the price lower to where they initially placed their long positions. That's a mechanism for them to put in more orders. That's something we refer to as position sizing. So let's say that even on that case, when the market was making a retracement, retesting that level, right, the supply zone, I mean the demand zone, right, which confluences with the formation of a right shoulder. Let's say you missed taking these positions here, so what can you do? And then the market actually pushed up, breaking the neckline. So what you can actually do is that wait for the market to give you a better position or give you a better price for you to end. Remember that if you try to execute long positions upon this level, this is an expensive price, so you can't afford to buy this at a very, very high price. So what you will actually do is that wait for the market to give you a better price. So when we say wait for the market to give you a better price, I'm talking about a retest, right? So this retest, basically, it's the bank traders taking profit from their initial investment, right? This is their initial investment, taking profit from their initial investment. So they've got long positions, which they actually place due to position sizing, because if they tend to place all of their orders at the very same time, let's say maybe they've got something like $1 billion or 1 billion orders they need to execute, $1 billion worth of orders they need to execute. So if they place $1 billion here and then find that the amount of retail traders coming into the market, they don't match up the orders that they actually plan to place, what will occur is that what will result is slippage. They will go into slippage and then they will lose money. So what they will in turn do is that they will do something called position sizing, where they split their orders into different proportions that match up the sell orders that are actually coming into the market. So remember that in the market, if you want to buy, you need to have willing sellers coming into the market. So these are willing sellers coming into the market, willing sellers coming into the market, willing sellers, and then you've got consolidation, resulting in willing sellers coming into the market and participating, placing short positions, because retail traders, they trade based on whether a support or resistance level got broken. So whenever they see this level getting broken or it's broken, so whenever they see price approaching this level but failing to break it, they always view it as a retest. So they place in short positions, therefore thinking that they're pushing price to the downside, but in the very same sense, they're providing liquidity to bank traders to actually place their long positions, right? So right now, on dollar or on volatility index, I'm actually expecting price to push a bit lower to the downside to give me a retest of the level in which it broke out of before I can start considering taking long positions. So if you're taking long positions around this level, you're basically hitting yourself. This is not a position where you can take long positions. The price is too expensive, it's too much, right? So you need to see price being lowered, therefore them giving you a better price before you can start considering taking long position. So the depth of the correction basically depends on the amount of retail traders coming into the market, right, placing long position. So the correction can go as far as here to retest this level here, because this level in which the market broke out of, this is actually a demand zone. So we can actually have even a deeper correction where the market retests the demand zone before we can continue heading to the upside. So that's one thing that you actually need to take into consideration whenever you have missed a trade. So you need to see the market giving you a better price. So if I don't get a better price, therefore I do not enter. So if I don't see price coming back to the downside to retest the level in which it broke out of, I do not enter, right? So if I enter, that practically it is a suicide mission, because I will end up losing money. What if there's an overextension where the market continue running to the upside, right? The market continue running to the upside before it actually gives me a correction of 61.8 fib level before it continues running to the upside, right? So those are one of the things that you have to take into consideration. So again, now looking at it from this perspective, you always have to go to a 15 minutes time frame, especially when you work with currencies that consist of a huge spread. So right now here, you can't take any long positions. Taking a hedge so positions will definitely, it can play out, but sometimes it has high probabilities of not playing out because you're going against the momentum of the trend. So if I were to take hedge positions, which I won't take hedge positions, I'll definitely take hedge positions on this level here, where I would take short position, pushing price to the downside, but yet at the same time maintaining a strict risk management of at least few pips above, right? So I'll be taking short position based on the fact that this is a demand, this is a supply zone. This is a supply zone that's actually formed by banks taking profit of their initial investment. So that's where I would take my hedge, and this would be my take profit, or I can trade it and then have a trade profit whenever the market hits the the demand zone before I can start considering long position. But hedging, it requires a certain level of skill, so I wouldn't advise someone who's still starting to actually start considering hedge positions. But like if you're already floating in a certain amount of profit, you can definitely hedge it out and see if it will play out. So if you hedge it, you then maintain a strict risk management, knowing that if it breaks above a certain key level, then you can start considering that your hedge has actually failed, and then just maintain your long positions and then ride them as far as you can. So I think that's one of the things that I would advise most people, that like whenever you missed an entry, wait for a retracement to occur, like wait for the market to give you a better position or give you a better price level before you start considering long positions. So if you like any of the content that I share, please don't be shy with that like button, so that like I can see that like you actually agreeing with the content that I share.